diversification is not the diversification. So if you looked at, I think it's the iShares Spain ETF. Let's say you didn't know much about stocks, but you read and you think, I think Spain's been oversold. It had its crises. It was a deep crisis, but they've recovered. The market hasn't come back. And it's a dynamic, it has its dynamic spots in the economy. I'd like to buy some. All I want is exposure to Spain.
Right.
Diversified exposure. So you buy this Spain ETF, and first of all, nobody tells you that the top 10 companies account for 70% of the weight. It's not diversified, number one. So now you're actually buying individual stock risk. Okay, I'm willing to live with that. But nobody told you that 6 of the top 10 holdings get 74% of their revenues from outside of Spain.
Yeah.
So buy Spain, you're investing outside of Spain, because these are multinational corporations. You're exposed to risks everywhere, whether it's REITs or Spain or emerging market bonds or emerging market stocks or large cap growth or small cap growth that are not what you're being told they are. They're really being driven by liquidity, meaning buying pressure for certain kinds of stocks, and low interest rates. And on your pie chart, you might look semantically diversified, and you're not diversified whatsoever. You're really exposed to one great big interest rate play. And fortunately, the response to that is to recognize that, we'll call it the ETF divide. So most of the world now looks at investing through the lens of indexation. Stocks fit into this vortex, or they don't. They can be excluded for reasons that have very little to do with how the business is doing.